Public Finance in India, Part 5, Balanced Budget. The concept of a balanced budget was advocated by the classical economists like Adam Smith. It was considered as neutral in its effect on the working of the economy, and hence they regarded it as the best. However, modern economists believe that the policy of balanced budget may not always be suitable for the economy. The modern governments are welfare entities, and hence they cannot keep their expenditure at the level of their receipts. Second, surplus budget. Government budget is said to be surplus when estimated government receipts are more than the estimated government expenditure, which is anticipated government receipts is greater than estimated government expenditure. A surplus budget may prove useful during the period of inflation. In the period of inflation, there is a tendency for prices to rise rapidly. This needs to be checked, particularly in the interest of those who have more or less of a fixed income. The rise in prices can be checked by lowering the level of effective demand in the economy. This can be done by increasing taxes, which would increase the revenue of the government and reduce the purchasing power of the people. As a result, the aggregate demand will fall, leading to downward movement in the price level. Thus, inflationary pressures can be controlled. However, a surplus budget should not be used in the situations other than inflation, as it may lead to unemployment and low levels of output in an economy. Third, deficit budget. Government budget is said to be deficit when anticipated government receipts are less than the estimated government expenditure. That is, anticipated government receipts is smaller than the estimated government expenditure. A deficit budget may prove useful during the period of depression. In the period of depression, all economic activities are at low levels, which result in unemployment. This can be checked by increasing government expenditure, by borrowing money, and through deficit financing. This will increase employment and aggregate effective demand for goods and services, which would encourage further investment. In modern times, deficit budget is the most commonly implemented policy of any government. Developing countries like India have consistently resorted to deficit budget technique for economic development. Importance of budget. Union budget is important because it affects people and economy in general in a number of ways. Taxes are the most interesting part of any budget. Taxes determine the fate of businesses and individuals. The level of disposable income of the taxpayers depends on the tax rates presented in the budget. Government expenditure on various heads such as defense, administration, infrastructure, education and healthcare, etc. affects the life of the citizen and overall economy. Also, budget is important because government use it as a medium for implementing economic policies in the country. Budgetary actions of the government affect production, size and distribution of income and utilization of human and material resources of the country. Thus, the scope and importance of public finance in a modern economy has undergone an immense change since last 100 years. Money market and capital market in India. Introduction. Finance is the backbone of an economy. Finance basically refers to the management of money. It includes funds needed by individuals, business houses, and the government for various purposes. Thus, finance is categorized as personal finance, corporate finance, and public finance. The financial system of the country is responsible for the mobilization and allocation of funds. It helps in creation of wealth, which is vital for the economic development of the country. The financial system in India comprises of financial institutions, financial markets, financial instruments, and financial services. This chapter deals exclusively with financial markets in India. Financial markets are an important component of the financial system. Meaning of financial market. Financial market refers to a market where sale and purchase of financial assets such as bonds, stocks, derivatives, government securities, foreign currency, etc. is undertaken. Financial markets operate through banks, non-banking financial institutions, brokers, mutual funds, discount houses, etc. Financial markets include two distinct markets, which is the money market and capital market. A. Money market in India. Meaning, money market is a market for lending and borrowing of short-term funds. It is a market for near money, which is short-term instruments such as trade bills, government securities, promissory notes, etc. Such instruments are highly liquid, less risky, and easily marketable with a maturity period of 1 year or less than 1 year. Do you know some financial instruments? Bonds refer to the debt instrument issued by companies or the government as a means of borrowing long-term funds. Equity shares refer to shares of a company held by an individual or a group. Derivatives refer to a financial security which derives its value/price from the underlying assets such as bonds, stock, currency, interest rates, commodities, etc. Government securities refer to debt instrument issued by a government with a promise of repayment at maturity. Trade bill refer to bills of exchange drawn on and accepted by a trader, which is trade acceptance in payment of goods. Promissory note is a financial instrument that contains a written promise by one party to pay another party a definite sum of money, either on demand or at a specified future date.